You are required to file an annual tax return, so you're doing tax preparation, but are you doing tax planning? What exactly is the difference between tax preparation and tax planning? I'm an active CPA and I spent about 5 years in public accounting doing the tax preparation. Today, as a retirement planner, our focus is much more on the tax planning. When you're working with a CPA, typically you're going to engage that CPA sometime in the first quarter after the prior year is over. They're going to obtain your documents, information, statements, and they're going to compile that snapshot of what the prior year looked like. The calendar year is over, and now that CPA, as the tax preparer, is performing and acting in a reactive nature. If you're working with a retirement planner, they're going to be talking with you and doing analysis during the current year to be able to identify opportunities and make decisions that are a best fit for you for that current year. So there's a big difference between that reactive and proactive approaches. So what exactly is tax planning? One of the objectives of having a tax plan is to pay the least amount of taxes possible throughout your pre-retirement and retirement journeys. Everybody out there knows exactly how much you have saved for retirement. We can total your investment accounts. But the goal of the tax plan is how much of that do you get to keep and spend? A lot of your retirement balances are in a pre-tax account, meaning you have the IRS as your business partner on those balances. Having a tax plan should position you where you get to keep and spend as much of your total retirement savings as possible. In order to do that, we've got to have an understanding of what the current tax environment looks like. Current tax rates are very much favorable to all of us. If you look at the history of the tax rates, the current federal tax rates that we have in place today are low. We like to think that they're on sale. The first federal tax rate is 10%, then we jump to a 12% tax bracket. It goes to 22, 24, and then goes up a couple more brackets from there. Most households operate in those first four brackets, 10, 12, 22, and 24. So those are the opportunities that we want to be aware of. You want to have a snapshot of what your current year financial picture is going to look like from a taxable income standpoint. Having this information will allow you to make the decisions on should you be saving pre-tax or post-tax in your employer plan or within your IRAs. Decisions like that is what's going to impact your total taxable income. If you agree that the current federal tax rates are favorable, that's where you want to make some of these decisions so that you can drive and control exactly what your total taxable income is going to be. As an example, let's say you have a $100,000 salary and you choose to do 10% into your pre-tax 401k. You're going to contribute $10,000 into your 401k, so you'll show $90,000 of gross income. The other alternative is that you do that 10% as a Roth contribution. In that scenario, you will still show $100,000 of total gross income. Whatever your gross income is going to flow through your tax calculations and onto the tax tables. Another opportunity you have to control your total taxable income is through Roth conversions. So what exactly is a Roth conversion? A Roth conversion is where you take some of your pre-tax retirement savings balances, convert that over to a Roth, which is now post-tax, and whatever amount that you choose to convert in a given year is going to be included in your taxable income for the year. Going back to the federal tax rates that we talked about that a lot of people feel are favorable, if you agree they're favorable, then now might be the time where you want to use more of these tax brackets while we have them in front of us. The current tax laws expire at the end of 2025, so beginning in 2026, these tax rates are set to be higher than what they are today. Let's look at an example. Let's assume that you are married filing joint, and you would show, if you did no other planning, $200,000 of taxable income for a given year. You're going to fully fill up the 10% bracket, the 12% bracket, the 22% bracket, and you're going to start getting into the 24% bracket. The 24% tax bracket goes all the way up to around $340,000. You're showing $200,000 of taxable income. That 24% bracket goes up to $340,000. So the opportunity you have is that you could show an additional $140,000 of income for the current year and still pay that same 24% marginal tax rate on any additional income. Here's where the Roth conversion comes into play. You have an opportunity to convert anywhere from zero up to that $140,000 and fill up that 24% marginal tax bracket that you have available to you for this current year. If you feel that that 24% rate is a favorable tax rate, that's a strategy and a planning opportunity that you may want to consider for the current year. Whether or not a Roth conversion is a fit for your plan for a given year is its own analysis and decision. However, if you do identify that a Roth conversion is a fit for you, being able to do a Roth conversion in a down market is going to make even more sense for you. It's a great opportunity. You can do this conversion while the markets are at a discount, get all those shares moved over to a Roth account, and when the markets recover, now you've got all that growth in a completely tax-free account. Subscribe for more information, and if you have any questions about your tax plan or Roth conversions, you can schedule a 15-minute retirement checkup call that is completely complimentary.